Hey everyone, and welcome back to Your Money, Your Way. I'm so glad you're here. Today, we are diving into a really juicy earnings report from one of Singapore's telecom giants, StarHub. And let me tell you, this one is a story about a company making a huge, high-stakes bet on its own future. StarHub just released their results for the first half of 2025, and it's a classic tale of two conflicting headlines. On one hand, they're making more money in sales, which is great, but on the other, their profits are in a free fall. They keep using this word aggression in their report, which sounds intense, right? But what does it actually mean for their bottom line and for anyone thinking about investing? Are they playing 4D chess here, sacrificing profits now to completely dominate the market later? Or are they just getting squeezed in a really tough fight? We're going to unpack all of it, piece by piece. Okay, before we get into the numbers, just that super quick disclaimer. This video is all for information purpose only. It's definitely not financial advice. Please always do your own homework or chat with a professional before making any investment. All right, let's do this. So first, who is StarHub? If you're in Singapore, you definitely know them. They're one of the main pillars of the country's digital life. We're talking the 4 key services: mobile plans for your phone, broadband internet for your home, entertainment through their TV packages, and a rapidly growing enterprise division. This is where they sell complex digital solutions like cybersecurity and cloud services to big businesses and the government. Now, you have to understand the telecom market in Singapore is a battlefield. Seriously, it used to be a cozy club of 3, but over the last 5 or 6 years, the whole game has changed. A 4th player, Simba, jumped in, and then a whole swarm of these mobile virtual network operators, or MVNOs. You've seen them, like Circles.life and Gomo. They all flooded the market. What happens when you have more sellers than ever before, all fighting for the same customers? You get an all-out price war. It's like when 2 supermarkets open on the same street, and suddenly the price of milk is practically free. That's what's happened to mobile plans. Prices have been dropping and dropping, which is great for us as consumers, but for the companies themselves, well, something's gotta give. And that is the perfect setup for the numbers we're about to see. All right, let's get to the juicy part, the headline financials for the first half of 2025. StarHub's total revenue, or their top line, hit 1.1 billion Singapore dollars. That's a 2.2% bump from last year. So, more money is coming in the front door, which shows they still have pulling power. This growth was mainly fueled by their broadband, enterprise, and especially their cybersecurity services. But, and this is the big but that changes everything, the profit story tells a very different tale. EBITDA, which is a common way to measure a company's core operating profit, fell to $203.3 million. That's a 9.1% drop from last year. That's not a small dip, that's a significant slide. And then there's the big one, the net profit attributable to shareholders. This is the actual profit that goes back to the company and its owners after all expenses. That number came in at just $47.9 million. Now get this, that is a 42.7% collapse compared to the same period last year. Wow, let that sink in for a second. A nearly 42% drop in profit. Now, to be totally fair, they did have a special one-time expense. They paid a $14.1 million forfeiture fee to the government for returning a block of 700 megahertz spectrum. Think of spectrum as a radio highway license for their mobile signal. They decided they didn't need this particular lane on the highway, but they had to pay a penalty to give it back. Even if we add that money back in to see the underlying performance, the profit is still down 23%. So the mystery is clear. Revenue is up, profit is way down. To solve it, we need to look at the different parts of their business. StarHub's 2 worlds, consumer and enterprise, are moving in opposite directions. On the consumer side, mobile, which is usually their cash cow, actually saw its revenue shrink by 5.4%. And here's the paradox. They have more customers than before. Subscriber numbers are up a very healthy 8.2%, mostly thanks to those aggressive, cheap SIM-only plans. But this means the average revenue per user is falling. It's like a cafe that's suddenly packed with people, but everyone is just ordering water. More people are coming to the party, but they're not spending as much at the bar. Broadband, though, was a real winner. Revenue there grew by 4.4%. They are the market leader here, and they're flexing their muscles. They're getting people to upgrade to faster, more expensive internet plans and bundling them with other services in their Infinity Play strategy. It's working. Their entertainment division, however, is struggling. Revenue fell over 9%. Let's be real, this isn't a huge surprise. With Netflix, Disney+, and a million other streaming options, the traditional cable TV model is a tough business to be in. But now let's look at the other world, the enterprise side of the business. This is where the good news is, and it is on fire. Revenue from their regional business clients was up almost 7%, and cybersecurity services, wow, that shot up by over 20%. This isn't just a side hustle anymore. This is their new dedicated growth engine. They're making a clear pivot from just being a company that sells you a phone plan to a company that secures the digital infrastructure of other major businesses. So how does this all compare to what they promised? Well, the revenue growth was solid, but that drop in profit, that was way below their own forecast. They had told the market to expect profits to be stable. So let's be honest, that was a miss. The pressure from the price war was a lot stronger than even they anticipated. And this is where we get the real story from the CEO himself. Nickel Apen basically said, and I'm paraphrasing the tone of the report here, look, it's a brutal market out there with falling prices, so we are choosing to be aggressive. We are going to fight for our market share, especially in mobile, so that when this storm passes, we're in the strongest possible position. That word again, aggressive. This isn't an accident. This is a deliberate, calculated choice. They are choosing to let profits slide so they can defend their turf and maybe even gain some new ground. Buying out the rest of MyRepublic Broadband is another piece of that puzzle. They're trying to consolidate their power and become an undeniable force. Now, this fighting stance directly shapes their outlook for the rest of the year. They've officially changed their forecast. They're no longer saying profits will be stable. Instead, they're now telling us to expect the full year EBITDA to be somewhere between 88 and 92% of what it was last year. This is them being transparent and saying, hey investors, this fight is costing us money and we're buckling up for it, you should too. But here's a very important piece of good news, especially for income-focused investors. They are still planning to pay their dividend. They've declared 3 cents for the first half of the year, and they're sticking to their promise of paying at least 6 cents for the full year. This is a huge signal. It shows that despite the profit dip, their underlying cash generation is still strong, and they have confidence in their long-term financial health. So, how do investors react to all this? Let's be real. It's confusing. A 42% drop in profit usually sends a stock tumbling, but some sophisticated investors might actually see this as a smart long-term move. It creates two competing stories. There's the profitability is king camp, who will hate these results, and then there's the market share is the long game camp, who might actually be encouraged. So, okay, let's put it all together. What does this actually mean if you're looking at StarHub? This is the core analysis. Let's start with the opportunities, the bull case. First, market consolidation. StarHub is using its financial strength as a weapon. A long price war bleeds out the smaller, weaker players. StarHub can not only survive, but it can also pick up the pieces, like it did with MyRepublic. They're trying to win by being the last one standing. Second, the enterprise pivot. This is their secret weapon. Selling cybersecurity and cloud solutions is a much higher margin business than selling cheap phone plans. If this division continues to grow at 20%, it could fundamentally change the entire company's profit profile in the next 5 years. And third, cost cutting. They're not just spending aggressively. The report also talks about a multi-year plan to decommission old systems and automate things. So they're trying to get leaner while they fight. But you always have to look at the risks. The bear case. The biggest risk? What if this price war never ends? What if cheap mobile plans are just the new reality in Singapore? In that case, their profits might never recover to their old levels. Second, there's execution risk. It's one thing to have a great strategy on paper, but it's another to pull it off. Integrating MyRepublic has to be seamless. And can they truly compete against specialized IT companies in the enterprise world? It's a whole different league. Finally, there's shareholder fatigue. How long will investors be willing to wait for this long game to pay off while profits are falling? That's a real question.
So honestly, an investment in StarHub right now is a vote of confidence in the management's gamble. It's a bet that they're right, that you have to bleed a little now to win the entire war later. And there you have it, the full deep dive breakdown of StarHub's latest earnings. It's a story of growth and pain, of strategy and sacrifice, a real corporate drama playing out right there in the financial statements. What do you think? Is StarHub's aggressive gamble a brilliant move or a huge risk? Drop a comment below. I'd love to hear your take on it. And hey, if this breakdown was helpful and gave you some food for thought, do me a huge favor and hit that like button. And of course, subscribe and ring that little bell so you don't miss our next deep dive. Thank you so much for watching, and I'll see you in the next one.